Wall Street is bullish on gold, forecasting a 30% increase for the year. Bank of America believes that the correlation between gold and the U.S. stock market is currently high, with both assets embarking on a rare fourth year of double-digit gains. This year, the S&P 500 index is expected to see an annualized gain of 20%, while gold is expected to reach 30%. Why does Bank of America believe there is a high correlation between U.S. stocks and gold? Following the Iran conflict, gold prices experienced a significant correction and consolidation, yet they still maintained a 9% gain for the year. Is it possible to reach Bank of America's projected 30%? Deutsche Bank, another major investment bank, also believes that the sole factor driving dollar hegemony has changed. Global foreign exchange reserves in US dollars have dropped from over 60% at their peak to just 40% today. Meanwhile, gold's share of foreign exchange reserves has reached 30% over the last 4 years. This means that most of the share lost by the US dollar has shifted to gold, and there are even new foreign reserve funds flowing into gold. Does this mean the era of the dual kings, gold, and the US dollar operating independently is approaching? Last Friday's non-farm payroll data was a major positive surprise, with 115,000 new jobs added, marking the largest increase since the end of 2024. As the gold hunter expected, if ADP employment growth is a reference, non-farm payrolls are likely to be positive. Does this mean the probability of a rate cut this year is off the table? I've included the latest real-time trading strategy at the end of the video, so be sure to watch until the end. Bank of America expects the S&P 500's annualized gain to reach 20% and gold's gain to reach 30%. This type of multi-year, large-scale rally is historically quite rare. Looking at the U.S. stock market, such sustained large-scale rallies have only occurred 3 times in the past. During World War II, the peace dividend period immediately following WWI, and the internet technology bubble from 1995 to 1999. Gold's equivalent rally was primarily concentrated in the stagflation period of the 1970s. However, with the changes in geopolitical risks and the political environment, U.S. stocks and gold now show a higher correlation. If we calculate based on this logic, with spot gold starting the year at 4332, a 30% gain would place the price at 5631. Spot gold hit a high of 5598 at the end of January, only $33 away from Bank of America's target price. Bank of America has almost achieved a precise prediction for the year's gold price rally. After the Iran conflict, gold prices fell sharply, currently recovering to around the 4,700 level. Assuming Bank of America maintains its current price target, they remain bullish on gold reaching the 5,600 range within the year. Even if we start from 4,700 and rise to 5,600, that is still a gain of 19%. I believe this possibility is quite high. The current convergence between U.S. stocks and gold is primarily driven by AI technology. AI spending has become a global focus, and the current leader of the U.S. stock market is the AI industry. It can be said that AI stocks have contributed over 90% of the gains in the U.S. stock market. The entire market is being driven by AI. The AI supply chain, particularly regarding equipment and material supply, is driving the entire commodity market, including gold, silver, platinum, as well as copper, aluminum, steel, and other metals. Although the rally in U.S. stocks may draw some safe haven capital away from gold and back into risk assets, it simultaneously boosts sentiment for gold. Market consensus forecasts indicate that the U.S. nominal economic growth for this year is expected to reach 5.5%, and corporate profit growth is estimated at 20%, providing fundamental support for a broader market rally. As for the driving factors behind US stocks and gold, they cover multiple aspects, including resource competition driven by geopolitics, rising global military spending, raw material demand fueled by the artificial intelligence capital expenditure boom, and building material demand driven by housing shortages in various countries. If Bank of America analyzed the correlation between U.S. stocks and gold from the perspective of risk assets and safe haven assets, leading to gold being pulled along, Deutsche Bank started from the perspective of currency and the U.S. dollar, articulating a strong case for the return of the gold king. Deutsche Bank believes that the conditions that established the U.S. dollar's reserve status in the 1990s, including unipolar hegemony, expansion of free trade, economic stability, and low inflation, have all quietly reversed. The U.S. dollar's share in global central bank reserves has fallen significantly from its peak of over 60 to 40%. Conversely, gold's share has nearly doubled over the past 4 years, climbing to nearly 30%, with the gap between the two narrowing to just 10%. Data from Deutsche Bank shows that the share lost by the US dollar has not turned to other fiat currencies, but has almost entirely flowed into gold, with incremental funds continuing to enter gold. Since the 2008 financial crisis, central banks in emerging markets have cumulatively purchased over 225 million ounces of gold, a volume exceeding the total gold sell, off by developed economies in the 1990s. Even more explosive, in Deutsche Bank simulations, if emerging market central banks, such as those in China and India, were to raise their gold foreign exchange reserve ratio to 40%, the price of gold could rise to $8,000. The primary purchasing power behind this gold bull market is Asian emerging market central banks and Asian investors. I believe this possibility is very high. Even calculated from the current $4,700, it is only $3,300 away from $8,000. With the ongoing release of geopolitical and political risks, the world is beginning to turn toward extreme polarization. Bank of America forecasts that gold will rise to $8,000 in about 5 years. I calculated it myself. The average annual price gain for spot gold over the past 5 years is $490. If we calculate based on this average gain, it would take about 6 years for gold to rise from $4,700 to $8,000, which is only 1 year off from Deutsche Bank's 5-year estimate. Of course, the average gain is just the most conservative estimate. For example, gold rose by $1,700 in 2025 alone. There are many factors involved that could cause gold to see a very large gain within 1 to 2 years. Data shows that as of the end of 2025, the physical gold held by emerging market central banks was 367 million ounces, while developed economy central banks held 712 million ounces. The former is equivalent to about 52% of the latter, whereas this ratio was only about 20% before the 2008 financial crisis. This means that since the financial crisis, developed economies have begun to stockpile large amounts of gold to hedge against future financial risks and to counter the long-standing hegemony of the US dollar. If we look at gold as a percentage of total reserves, the gap is even more pronounced. As of the end of 2025, gold accounted for 34% of total reserves for developed economy central banks, while for emerging market central banks, it was only 16%. This discrepancy also means that emerging markets still have considerable room for increased holdings. To summarize the views of Bank of America and Deutsche Bank, Bank of America believes that the correlation between gold and US stocks is extremely high. The S&P 500 is projected to gain 20% by 2026, and gold is projected to gain 30%. Gold's gains might even exceed those of the S&P 500 thanks to the AI supply chain driving the entire commodity market, especially industrial and precious metals. Therefore, a rally in US stocks will also drive a rally in gold. Deutsche Bank, from the perspective of the US dollar and gold, analyzed the future of both, concluding it is highly probable that both the US dollar and gold will be established as dual kings, with both serving as reserve assets for global central banks. The main buyers of gold have shifted from developed countries to emerging nations, which will remain the primary drivers of gold buying for a long time to come. And this gold bull market is being driven by emerging market investors. Aside from the big investment banks' predictions, last Friday's non-farm payroll data showed a major positive surprise which was in line with my expectations. The US added 115,000 non-farm jobs in April, far exceeding market expectations and marking the largest increase since the end of 2024. The unemployment rate held at 4.3%. Although the current unemployment rate is relatively high, the number of new jobs added has increased significantly. It was only expected to be 65,000, so the new job additions have nearly doubled. The market will not be so focused on the unemployment rate. The emphasis is on the substantial increase in the number of employed people. Following the non-farm announcement, gold prices experienced a slight correction, but the impact was not significant. This is enough to prove that Chairman Powell's decision to stay put was the best outcome. Know that the employment situation has been confirmed as stable. The Fed's attention is almost entirely focused on inflation. It can be said that the possibility of a Fed rate hike and the possibility of a rate cut have equalized to 50-50ths, much like the probability of flipping a coin. And right now, I believe that the probability of a rate cut this year is even lower than a rate hike. The U.S. Consumer Confidence Index has hit a historic low for 2 consecutive months. The Iran conflict has driven up oil prices, which in turn has driven core inflation, and Trump's new tariffs have begun to be implemented. Currently, inflation is being held hostage by both oil prices and tariffs. To be honest, I don't understand Trump's erratic actions. According to Trump's campaign manifesto, low inflation and low prices are his core competitive advantages. If the goal of targeting Venezuela and Iran was to lower domestic oil prices, it is clear that he has failed in the case of Iran, unlike Venezuela, and has clearly suffered a setback. Imposing tariffs is even more confusing. Tariffs transmit to the economy much faster than oil prices. As long as the policy is announced today, it can affect the price of imported goods by tomorrow, whereas oil price transmission to consumer prices takes 1 to 2 months. In terms of keeping prices low, he is clearly an unsuccessful president, with the Fed having confirmed that oil prices and tariffs have not had much impact on employment numbers. Inflation has become the only major factor, and since current inflation simply cannot be brought down, a rate cut this year is unlikely, unless prices return to normal levels. The summary of key news is complete. Back to the technical analysis of gold. Due to the positive non-farm employment data and oil prices rising again at the start of the week, gold opened lower today at 4669, but found support at the blue tunnel level. From the current price trend of gold, an M-top structure has formed. There are generally two ways an M-top plays out. Once the top is formed, the structure remains intact. The first scenario is a jittery downside, maintaining the current M-top structure, where the price drops and confirms the top. The second scenario is a jittery upside, where the M-top is no longer an M-top, but becomes an M-bullish relay pattern, where the price rises and negates the top. However, since we don't know whether the market will rise or fall, we will treat it as a top for now. Without any unexpected negative news, I feel the probability of an M relay pattern is greater than the M-top breakdown. Of course, this assumes there is no major negative news for gold. Otherwise, technical analysis will fail. Technical analysis is more effective in shorter timeframes. The longer the interval, the lower the effectiveness, as the market is complex and influenced by many factors. If Trump does something random, no matter how good your technical skills are, they won't work well, as there is a high probability of being caught on both sides of the market. Therefore, we need to avoid uncertain trading factors, such as important speeches and routine economic data, and seek a degree of certainty before trading. If you have a solid level of technical analysis skills, you have a high probability of making money. The above market analysis is purely my personal sharing, does not constitute investment advice, involves risk, and please remember to use stop losses. Finally, please subscribe to my channel, hit the notification bell, and see you next time.